I think we are good to go now. So let's continue from where we stopped. But I'm sure that you understand what I was taking you through the other time. Certainly, sometimes your question can come, you will see it, it looks so simple, but at the same time, it will be, if you are not careful, you will just make mistake. Mr. Buala, please, you are raising your hand. Go ahead, please.
Good evening, sir.
Welcome, Ogasa.
My confusion is with this accounting profits. So we are
Okay.
taking 121 as the accounting profit, and then you are charging 30% tax, deducting 30% tax. Before you now do your admissible and inadmissible add back disposition, then use that amount to charge tax again.
Okay,
Haven't we
maybe,
charged tax twice? So
now
maybe
maybe
the accounting profit is it not supposed to be profit before tax?
oh, apologies.
Because
Oh,
thirty
sorry,
percent.
sorry. Thank you, Mr. Buala. You are thank you. Sorry, sorry. Oh yes, that's true. I'm removing tax twice. Sorry, please. Thank you so much. You have made me. You are actually correct.
Okay, sir. Thank you.
Hold on. Let me be sure. We are correct now. What we have done is correct. Please let me explain it to you. Maybe it's the way I did it now. Let me do it
Okay.
in a straight line way so that you will have understanding of it, please. Maybe it's the way I
Okay, sir.
complete it. Now let's go back, please. Let's go back so that we can understand. Let me do it in a straight way, what you used to know, so that
Okay.
we know what I've deleted it now. So let's go, please. What is the profit before tax? Profit before tax
I
is
don't.
what, please?
I don't have the screenshot, but I think it's 121.
1 to 1. Okay, let me go back. Let me scroll up so you can see it. The yes, see it here. Profit before tax is 121. Is that not so?
Yes, sir.
Profit before tax is not your accounting profit. It is it is a profit before tax. It is when you have determined, when you have removed tax from it, that it becomes the profit for the year. Profit for the year is known as accounting profit. That is the profit that the management declare for the year. That's what we call accounting profit.
Yes, sir. I
Is that
understand,
taken
sir.
now? Is that you
Yes,
understood
sir.
it now? What we have
Yes, I
as
understand.
121 is profit before tax. Is it clear now?
It's
So
clear,
now
sir.
profit before tax is 121. So if
Yes,
it
sir.
is 121, oh yeah, please, 121. Meaning we are going to charge tax for the year. Tax for the year. Our tax for the year is what? 30% multiplied by profit before tax. Is that also?
Yes, sir.
And what do you have?
36.3.
36.3. Okay? You have 36.3. If you remove 36.3, 36.3 from 121, what do you have?
84.7.
Sorry, 1 minute, please. You have 84.7. Let me just delete all of these so that we'll start all over again. 84.6. Okay. Sorry, please give me that tax again. What is our tax for the year?
36.3.
36.3. So I don't want to assume that you know this thing. Before I was thinking, all of us will know it. So we did it in our elementary, you know. So thank God you even
So
got
you
it
know,
right.
it's not the calculation. My confusion is still the fact that we are deducting tax here. Then after we do the adjustment, we are still after the adjustment and the capital allowance. Then we charge tax again.
Okay.
That's my
Okay.
confusion.
Okay.
So which tax is it? Are we crediting to liability and debiting to the income statement?
That's why, you know, okay, maybe you didn't allow me to learn with my explanation. That's why I was explaining before the time went off the other time. That what I did together here were I did two treatments altogether. One is the accounting profit and the accounting tax for the year. And the second one is that of the tax authority. You understand? What the tax authority will compute. You understand? Why I'm doing that is, you understand? Why I did that is, I know too well that, you know, there will be a difference. And this difference will always give rise to over provision or under provision, that is overestimation or underestimation of your tax, current year tax.
I get it. I understand.
Okay. You have made me to delete all the things I've done before.
Control Z to come back. Control Y.
No, there's no time for those one now. But you understand, everybody understood what we have done so far, right?
Yes, sir.
Okay. So what I just needed to do for me now is what was the accounting tax that we got? Accounting tax is what?
That's okay.
84.7.
34.7.
84.7.
The accounting tax. It's 36.3 now.
That's it. Look at it up there now. It's written there, sir.
36.3. That's what we got. Is that not so?
Yes, sir.
Now, the tax authority tax. Tax authority for current year tax. Let me put this one in bracket. Is 24. So you can see now, this company now, look at it very well. The accounting tax that they got is 36.3. Is that also? Are we together?
Yes, sir.
36.3
Yes, sir.
36.3 is what they got. But when we use the tax authority tax computation, we have what we call we have 24, meaning that the people that prepare the management account for this entity, they said that the tax for the year was 36. If that company carried this tax, debit their pure head with 36.3, credit their current liability with 36.3, they have not done anything bad. If assuming they have paid this amount 36.3 to the tax authority, they have also not done anything bad. But it is expected that before you pay, that's why they give that allowance, that if your account here, for instance, is running from January to December, you have the opportunity to offset or file a return of your tax for the current year in the future year before the 30th of June of that year. Why do they give that allowance? So that if you have the experience, you can calculate yourself what exactly should be the tax that you pay to the authority by itself, or you give it to an expert, a tax expert, to help you compute it, or you wait for the tax, or you invite the tax authority to help you compute it so that you will remit the current amount. Now, if we check this accounting tax, we have 36.3. The one computed by the tax authority is 24. Let's assume that this company, they paid it 36.3, or they have provided 36.3 as the tax for the current year. And when the tax authority compute their own, it was 24. It simply means that there is over provision. And this will lead us to another topic under IS 12 known as over and under provision for the current year taxes. Is that okay? Over provision and under provision of current year taxes. What is over provision? Over provision simply means that the amount estimated or calculated is higher than the amount that was eventually paid. Remember, the amount usually that are eventually paid is the amount that is being computed by the tax authority and agreed with the entity, looking at their trading activity and all the available documents and reports that are given to them. So when the amount estimated or calculated, from the accounting profit, as it were, is higher than the amount that was eventually paid, that is, the amount calculated by the tax authority, we have over provisions. If reverse is the case, where the amount calculated or estimated or provided for is lower than the amount that is eventually paid, there is what we call under provisions. Your over provision will make the tax authority to be owing you if actually you pay that amount that you over provided for. Under provisions will make you to be owing the tax authority if actually what you pay is the amount that you actually calculated. I'm just taking this thing in a layman way so that you can understand it. I don't like using those technicalities, so that if you understand it literally, you can always utilize it in your day-to-day activity, not only for exam purpose. I hope that is clear. Current year tax will lead to either, usually, no matter how, you can never get the same thing with the tax authority. So usually, you always have what we call over provision and under provision. Summarily, let me just summarize so that we can move to deferred tax. We have current year tax. We have defined it as the amount payable to the tax authority from your trading profit in the current financial year. That is what we call current year tax. And we said that your current year tax can be computed by, adjusting, that is determining your adjusted profit and multiplying it by the tax rate. And we said that this can lead to over or under provisions. Over provision means the amount you calculated or estimated is higher than the amount that was eventually paid. Under provision means the amount that you provided or calculated is lower than the amount that is eventually paid. So it's as simple as that. Income tax is one of the simplest standard and simple standard. Once you know everything that I've said now, you can easily move around it. Now let's quickly look at this question before we go to the next subtopic, which is a deferred tax. The following relate to Albert Nigeria Limited. Profit before tax 1,316,000. Tax for the year 394,800. Can we see this question, please? You can screenshot it. Tax for the year 394,800. Profit for the year 921,200. Provision for the year 383,000. Income tax paid on 4th of February 2004 is 300,000. Required. Advice Albert Limited. Now please, I want you to look at this question and tell me if what we have is over or under provision. Quickly, under 1 minute, please, let's look at it together. What we have, is it over or under provision? Are we okay? Okay. Taufik, go ahead. Okay. Olamilokun.
I'm here. I'm talking.
Okay, go ahead.
Sir.
It's over provision, sir.
Over provision. How did you get it?
The income tax for the year for before 100,000 tax.
You barely can. Okay, thank you so much. Joy, please go ahead.
Okay, good evening, sir.
Welcome.
So I think is under provision,
Okay.
since the tax for the year is 394,800, while the income tax paid was 300,000.
What is the definition for under provision? Joy, don't go. Speak, oh.
Sir, you said the amount under provision is when the amount calculated is lower than the amount paid. Hello, sir.
Say it again, please.
You said under provision is when the amount calculated is lower than the amount paid.
So now, is the amount calculated lower than the amount paid?
Okay, sorry. It's over.
Okay, it's over.
Thank you.
Okay, thank you so much. And
Thank you,
please, I just saw, I was running through what Mr. Buala was asking me the other time. Please, let me take you back. It's better we get it right now. Now, I think I know too well. It's not that I think. I know too well that I've made a mistake here. Your profit before tax, since they did not charge tax for that year, we are not supposed to actually tax this tax. We are not supposed to charge. Okay, we are actually correct. You are correct. But I don't think this is right. The right way to go about this under financial accounting. This tax that we are charging here is not correct. We are not supposed to charge tax here. We are actually supposed to add back the disallowable expenses. We get our adjusted profit. But then we can do it. It's a two-way thing, sure. We are correct this way. You can also do it the other way around, and you also arrive at the same result. Let's go ahead, please. I think I was just thinking, and I think we're in line. I don't want to teach you error. So please, that is that for under and over provision. Let's go to deferred tax so that you can go and rest tonight. What is deferred tax? Any question before we hit this deferred tax? Any question, please? Okay. In absence of any question, please let's go. Deferred tax. What are deferred tax? Just as the name implies, deferred. Deferred means difference. So when we talk about deferred tax, it is a temporary difference that occurs between the carrying amount of an asset and its tax base. It's as simple as that. The temporary difference that occurs between the carrying amount of an asset and the tax base of an asset at the measurement date. Let me just put that one. The carrying amount of an asset is usually the cost of an asset less its accumulated depreciation. Whereas the tax base of an asset is the cost of an asset less its capital allowances. Are we together? Let me take that again.
Please, can you come again, sir?
I'm coming again. Deferred simply means the temporary difference that occur between the carrying amount of an asset and the tax base of an asset. That's full stop. The carrying amount of an asset is the cost of an asset less its accumulated depreciation. Whereas, when we talk about tax base simply means the cost of an asset less its capital allowances. Now, let me explain it so that you understand it. Carrying an amount of an asset, they are being determined by you, looking at the cost of an asset and, removing all the depreciation elements from the cost of an asset, and that will give you what we call usually the net book value or the carrying amount of the asset. According to the tax law of the land, depreciation is not an allowable expenses. And this is always what will bring concerns or issues between management accountant and the tax authority itself. Now, where I'm driving at is this. You have, as an entity, you have calculated that this will be the carrying amount of your assets, having deducted depreciation. The tax authority will come to you and say, no, that amount that you are carrying as your carrying amount is not correct, because we do not recognize or know what is called depreciation in the eyes of the law. What we know is known as a capital allowance. So now, when you have calculated your carrying amount for the year using all the principles available in the standard required, you have followed it. You have determined your net book value for your asset for the year. You need to compare it with the tax authority position. In the process of comparing it, there will always be differences. Why? Because the tax base uses this formula known as a cost minus the capital allowance to determine what we call the tax base of an asset or liability, as it were. Whereas the management accountant or the people preparing the profit or loss account the financial position of an entity will always use either the historical cost or fair model, if it's a subsequent measurement, as it were, to determine the carrying amount of the asset. Now, that differences that will always occur is what we refer to as a deferred tax. So, deferred tax are the differences that occur when you are comparing the carrying amount of an asset with the tax base of an asset. A good example is this. You have a value of PPE. Let's assume the value of your PPE, property, plant and equipment, as of today is let's say the cost is 500,000. And we were told that the property, plant and equipment have 10 years life, as it were. The cost is how much? 500,000. The life of the asset is 10 years. We were told that we can use straight line basis in our evaluation, How do we determine our carrying amount? Our carrying amount is by dividing the 500,000 by 10, and that will give us 50 as a depreciation. 50,000 will be the depreciation for the next 10 years. If 50,000 will be the depreciation for the next 10 years, assuming that this is the third year that we have, maybe we bought the asset 3 years ago, this is the third year that we are computing our, that we are determining the value of the asset. It means that by now, 3 years depreciation is what will be the accumulated depreciation. And that 3 year depreciation will be 150,000. 500 minus 150,000 will give us 350,000. Therefore, the current amount or the book value of that asset as of today, after the 3 financial year, the third financial year, is 350,000. Now, if you are to compare these, or let's assume the PPE has what we call capital allowance that has been given to it, granted by a tax authority. The cost of the asset is 500. Let's assume that the capital allowance that is given to this asset was 10%. No, let's just use 10%. Let's use 5%. That you are to recognize capital allowance on this asset at 5% rate for the next 10 years. Please, what will be the 5% of 500,000? That should be 25,000 if I'm not mistaken. Please help me calculate if you have a calculator. If you have a calculator, please help me calculate it. What do you have?
25,000.
25,000. Now, if 25,000 is the capital allowance for each of the year, it means that in the next 3 years, 75,000 will be the capital allowance, accumulated capital allowance. Remember, they cost the 500,000. 500,000 minus 75,000. That will give us 425,000 as the tax base. Now, remember, we calculated before that the accumulated depreciation was 150. We have removed 150 from 500. We have 350 as a carrying amount. Now, if you are to compare 350 with 425, there is a difference. And what is the difference? The difference is 75. That 75 difference is known as is what we use to compute your deferred tax. So that difference is what we know as a temporary difference. Is it clear? I'm sure it is clear. How do you calculate deferred tax? Please, if you don't understand, just call me back. I have your time. Me and Unana, we did tonight together. If you don't understand what I've just explained, let me know. Is it clear to every one of us? Are we still together? If we are not together, let's know. Thank you so much. So, how do you calculate temporary difference? Step 1, determine its temporary difference. Step 2, multiply the temporary difference by the tax rate. It's as simple as that. Step 1, determine the temporary difference. Like in the example that I've started now, that temporary difference was 75. Is that not so? Now say multiply the temporary difference by the tax rate. Assuming the tax rate is 10%, it means that our temporary difference, it means that the deferred tax for this year under evaluation will be 75 multiplied by 10%, and that will give us a deferred tax of 75. Now, understand that just like you have over provision and under provisions, Deferred tax can also give rise to what we call deferred tax asset and deferred tax liability. Deferred tax asset and deferred tax liability. How will you determine this? How will you determine this? Now, deferred tax asset, it arises when the tax base of an asset is higher than the carrying amount of the asset. Let me take it again. Deferred tax asset we will call when the tax base of an asset is higher than the carrying amount. In other words, when you have the tax base of the asset being higher than the carrying amount, it means that the tax authority are owing you. And that amount that they are owing you, you carry it in your book as an asset. Now, if it is recoverable within 1 year, you recognize it under current asset as your deferred tax asset. If that amount you know too well, you can recover it, or you can deduct it maybe from your current year tax, from the tax that you have to pay for your current year deductible. If you know too well, it will take place certainly within 12 calendar months. You are going to recognize that deferred tax asset under your current asset. But if you know that it will be more than 1 year for you to recover it, you are going to recognize it under your senior financial position, under your non-current asset. That is why if you have picked up a financial statement, so many times you will have seen deferred tax asset under non-current asset as well as under current asset, or you see it under current liability and under non-current liability. So like I was explaining, deferred tax can give rise to deferred tax asset. That is a claim from the tax authority. And it can as well be a tax liability that is a claim from the tax authority. Do you understand what I just said? Deferred tax asset is a claim by an entity from the tax authority. Why deferred tax liability is a claim from the tax authority by the tax authority from a trading entity. In other words, deferred tax liability arises when the carrying amount of an asset is higher than the tax base. It's as simple as that. I'm sure you understand it. Any question before we take illustration? Any question? Is it clear? Please, is it very clear? If it's very clear, please just give me a high five so we can proceed. Okay. Thank you so much. Therefore, that with it, don't be confused with it. Don't be confused with it. Don't be confused with it. It's as simple as this. So therefore, I've given you how to set it. I said step 1, temporary difference, and then multiply the temporary difference by the tax rate. Let's look at this question together. The following information relates to the abridged information provided by Tayo PSC, an oil company operating in Port Harcourt. These are the year, please, if you can snapshot it, I will be very, very happy. These are the year, PPE carrying amount is 300. The tax base is 250, and like that. I'm sure you can see it. Required. Advise Tayo PLC on the amount of deferred tax on the amount of deferred tax to carry in its book. Oh yeah, all of us, we are doing it now. I will not solve it too. It's you people that will solve it. Oh yeah, give me answer. Are we still together?
Yes, sir.
Oh yeah, now. Give me answer now. Or I should solve this one, then you solve the next one.
Let's do this one together, sir.
Okay. Step 1, I say determine. What is step 1?
Determine the temporary difference.
Temporary difference. Thank you. And how do you determine it? It is by, removing the PPE carrying amount, the carrying amount, and from the tax base. So therefore, the temporary difference now will be for year 2011. What will be the temporary difference?
50, sir.
50.
Oh, sorry.
50, sir. 2021.
Okay. 2021. So we have the temporary difference 50.
Now lose the chance. Tax.
2022.
5.
5, sir.
5.
2023.
10, sir.
10. Understand. Negative.
Negative 10. Now, who can give me the interpretation of this?
50 is the liability.
Come again.
50 is the liability.
Okay.
Deferred tax liability. 5 is also a deferred tax liability. And 10 is an asset.
Okay. I think. Sorry, please. Let me go with
Sir, for year 2021,
I'm
it
coming.
will.
Please, 1 minute. This is how I love to always give it to my students. It's better this way. Always put the tax base up first. When you put the tax base up first, it will help you to know whether it is an asset or a liability. Do you understand now? Is it clear? Because if it is positive, it is an asset. If it is a negative, it is a liability. Is that not so?
Yes.
Yes, sir.
Because this small thing you are saying like this. This question that I brought up like this was one of your past questions. They put 3 marks there. What is the temporary difference? You can imagine if you have 3 marks, you are only looking for 47 to pass. Look at it. Temporary difference. We have it as 50 for 2021, 5 for 2022, and 10 for 2023. So somebody was trying to help me explain it the other time. Interpretation.
Yes, sir. So,
Okay.
from your explanation and what I understand so far, for the year 2021, I think that it's a taxable temporary difference in the sense that the tax base is lower to the carrying amount of the asset, and it's an asset in this case. So it simply means that the taxable temporary difference for 50 naira, sir.
Thank you so much. Another person? Can any other person help me with? Okay. Idris. Temi talk. Well, I hope so. Olamiloku Ibrahim, please go ahead.
Yeah, good evening, sir.
All right, this
So
is
for
Temi.
year 2021, the temporary difference is -50. So that's a deferred tax liability.
Please help me
Then
clap for
for
her. Help me
20,
clap for her. Help me clap for her. I'm giving you 1 mark. Claim it, 1 mark. You are looking for 49 to pass FR, CR, I mean.
thank you. So for 2022 is also a deferred tax liability. Then
Okay.
2023 is a deferred tax asset.
Asset. Thank you so much. It's as simple as that. So, Aisha, do you understand it now?
Not really, sir.
Okay. Thank you that you. Let me just take
Okay,
it back. Go ahead.
all right.
Go ahead.
All right, I wanted to explain to her. So, according to the explanation that was given, when the tax base is higher than the carrying amount, that is the net book value of the assets, then you have a deferred tax as assets. But when your carrying amount is higher than your tax base, then you have a deferred tax liability. So that's why 2021 is a liability because the tax base is lower than the carrying amount of the asset. Also for 2022 is a liability because the tax base is lower than the carrying amount of the asset. But in year 2023, we can see that the tax base is higher than the carrying amount of the asset. So we have a deferred tax asset in year 2023. Thank you.
Temitope, you
Thank
are ready.
you.
You are ready for FRO. Just go and write. Don't read again. No. In fact, I'm giving you 5 marks now. I'm not giving you 1 again. I'm giving you 5. I've given you 5. You are looking for
Thank
45.
you, sir.
So, Aisha, do you understand it
Thank
now?
you, sir.
You see, this is how to understand it.
Yes, sir.
Eh? This is how to understand it. Tax base belong to the tax authority people. Carrying amount belong to the trading entity. Do you understand now? Now, if what the tax authority calculated as the base of an asset, what they have calculated, or what do you have helped, or the expert have helped them to calculate, is higher than what you yourself as a trading entity have calculated, it means that the tax authority, they are owing you. So what they are owing you is a tax, is a bonus to you. It's a bonus to you. So you carry it as your asset. Do you understand it now? But when
Sir.
it is the other way around, your own, the one you calculate as a trading entity, is higher than the one that tax authority calculate. You are the one owing them. And if you are owing someone, is that a liability? Eh? You are not answering me now, eh, Aisha?
It is a liability, sir.
Thank you. Thank you. So that
It's
is
a
that.
liability, sir. I'm answering, sir.
Okay.
Yes,
Thank
sir.
you. So that is
Thank you,
how
sir.
so that is how it is. And I told us, I said, once it is a liability, you take it to your statement of financial position. It's as simple as that. If it is an asset, you take it to if it's an asset that will be recovered or deducted within 1 calendar year, you recognize it under your current asset. If it is the one that you will deduct or recover above 1 year, you take it to your non-current asset. If it is the one that you will pay back, that is now if it's a liability, the one that you will pay back, and you are certain that you are going to pay it back within 1 calendar year, you take it to under your current liability. And if it is the one that you will pay back maybe above 1 year time, you can take it to your long-term liability. That is why you can have deferred tax asset under current liability. You can have deferred tax liability under current liability and under non-current liability. You can also have deferred tax asset under current asset and non-current current asset. Is that taken? You are not answering me. Oh. You are tired?
Yes, sir. We are hearing.
Okay, thank you so much. We are
Yeah,
concluding the
we
class.
finish, sir.
In the next 5 minutes, we should be done. But note this. Temporary difference do not only occur as a result of the difference between carry amount of a non-current asset and its tax base. It can also happen, the differences between current assets, the tax base of a current asset, and the carrying amount of a current asset. So it's not only non-current asset too. If current asset too, is being compared with its tax base and there are differences, it can result to a temporary difference. Also, when there is a revaluation gain on an asset, it can also result into temporary difference. Differences of accumulated depreciation, capital allowances, liability, all of these can also bring about a temporary difference. But usually you used to have the comparison of assets. Because I don't know how you want to determine the realizable, the tax base of a current asset. For instance, inventory. How do you want to determine it when I don't think that I have not seen any allowance that is given by government as to how to calculate what will be your allowance on all those current assets. But question can come like that. That's why I'm bringing this up now. So that is that for us. So now this is what we are going to consider under IAS 12. It's as simple as this. Don't let anything or anybody confuse you. Current year tax is being calculated by multiply your taxable profit with the tax rate. And that gives you your current year tax. You debit your POL, credit current liability. Simple. It can result to over or under provision. Over provision simply means that the amount you have estimated or calculated or that you have provided for is higher than the amount that you eventually paid. That is over provisions. And I told you that when you have over provision, it means that the tax authority are the one owing you. So you have the right to deduct whatever it is that you have over provided for. If actually you have paid it, as it were, you have the right to deduct it. If you calculate it in the next year tax, you have the right to remove it from the next year tax. Now, also, there is under provision. Under provision simply means that what you have calculated or estimated or provided for is lower than the amount that you actually expected to pay, as the case may be. If it is lower, it means that you are the one owing the tax authority. You have to make it up. And that is how it becomes an additional expense and to you. It's as simple as that. And then we look at deferred tax, and I told you deferred tax is the temporary difference that occur between the carrying amount of an asset and the tax base of the asset. And how do you calculate it? Is by number one, determining the temporary difference, and then step two, multiply the temporary difference with the rate, and that will give you your answer. The question we are actually looking at, we have not completed it. We have not completed that question. If we check it, we have gotten our temporary difference. That is step one. Step two, we have to multiply the tax base by the tax rate. We are given the rate of 20% here. So, meaning that for year 2021, to be 50 multiplied by 0.20, and that will give us our tax rate. It's as simple as that, please. Just multiply it, whatever you have, that will give you our temporary difference that you are going to carry in your book. It's as simple as this. Any question, please? Any question? Is it all clear?
Are we going to multiply our temporary difference, all our temporary difference with the tax rate, tax base?
Yes, with the tax rate.
Yeah, with the tax rate, I mean.
Yes, you are going to multiply it with the tax rate. Multiply the temporary difference by the tax rate. That is step 2. Once you multiply 20% by this, by 50, by 5, by 10, it gives you what you have to carry in your book as it were. It's as simple as that. Is it clear?
Yes, sir.
Thank you so much. Any other question? Any other question, please?
Good evening, sir.
Oh, okay, Rachel.
This is
Good
not a
evening.
question. When are we going to get the previous materials
Ah,
for the previous courses?
latest on Monday, all the materials will be available, I assure you.
Okay, thank you, sir.
All right, thank you too. Any other question?
So now, sir,
Yes.
one more question, sir. For this step 2 now, is it going to stop here? The question is going to stop at once we get our rate, once we multiply our rate with the temporary difference. Is that where we are going to stop?
That's where you are going to stop. Whatever you get there is what you carry to your book. This liability now, you take it to non-current liability, and the asset you take it to non-current asset as deferred tax liability and deferred tax asset. 50 multiplied by 0.20 will give you what?
10.
That 10, you take it to non-current liability. Now, also let me state it now. If the question did not tell you that they will recover the asset in 1 year's time or within 1 year, if the question is silent, as this one is silent, always take your value to the non-current asset, non-current liability, as the case may be. Is it clear?
Yes, sir.
Thank you so much. So, I hope I have not wasted my time tonight. You have added knowledge. And if anything they bring under S12, I'm so certain that you can deal with it appropriately. Is that not so? Thank you so much for your time. I'm indeed very grateful for staying put. Please, for those that have not paid for the material, don't ask me for material. For those that have paid after this class, no, on Monday, please, just DM me. I will get us this material across to you. I think I'm owing you about 2 or 3 materials now. Just DM me, I will forward it to you. But I hope this is simple enough, it's clear enough. You can deal with every other thing that you see. Is that not so? Thank you so much. Well, we see again on next week by God's grace. We see, and hopefully these videos will also be uploaded between today and tomorrow. Thank you so much for your time. I'm most grateful for allowing me to take you through tonight. Have a very wonderful night rest. The Lord bless you. Thank you so much.